Why hasn't a mathematical model to beat the stock market been found? For decades, investors, academics, and data scientists have been searching for a mathematical model that can consistently beat the stock market. Despite advancements in computing power, machine learning, and financial theory, no universal formula has emerged. The dream of a perfect market-beating strategy remains elusive, and there are several fundamental reasons why. One of the biggest challenges is the efficient market hypothesis, EMH. This theory suggests that stock prices always incorporate all available information, meaning that any potential advantage a trader identifies is quickly absorbed into the market. If markets are truly efficient, any predictable pattern disappears as soon as it is discovered and exploited. Some critics argue that markets are only semi-efficient, meaning that temporary inefficiencies can exist, but even those tend to vanish once traders start acting on them. As a result, any mathematical model that works for a while is unlikely to keep working in the long run. Another issue is the inherent randomness and chaotic nature of financial markets. Markets are influenced by a vast number of factors, including investor sentiment, economic trends, political events, and unexpected crises. Small events can trigger massive, unpredictable price swings. For example, a simple tweet from a major CEO or a sudden regulatory decision can send stock prices soaring or crashing. The 1987 Black Monday crash and the 2020 COVID-19 market plunge are both examples of how quickly markets can move in ways that defy traditional models. Chaos theory suggests that even the smallest changes in initial conditions can lead to massive, unpredictable consequences, making it incredibly difficult to create a model that can consistently predict market movements. Markets are also highly adaptive. A successful trading strategy does not stay secret for long. The moment a profitable pattern is discovered and traders start using it, the advantage disappears. This is especially true in the age of algorithmic trading, where hedge funds and high-frequency traders, HFTs, deploy sophisticated models that can detect and neutralize profitable strategies almost instantly. An example of this is arbitrage. Once a price discrepancy is found, traders rush to exploit it, and the opportunity disappears in milliseconds. This competitive environment ensures that no single model can maintain a consistent edge indefinitely. Data limitations and overfitting are also major hurdles. Many trading models rely on historical data, but markets evolve, and past performance does not always predict future results. Overfitting happens when a model is too closely tailored to historical data, identifying patterns that worked in the past but are not actually meaningful. A strategy that appears successful in backtests may completely fail in real-world trading because it was optimized for specific past conditions that no longer exist. A striking example of this was the 2008 financial crisis. Many models failed to predict the collapse because they were based on historical data that treated mortgage-backed securities as low-risk assets, an assumption that turned out to be disastrously wrong. Human psychology adds another layer of complexity. Markets are not purely driven by logic. They are influenced by emotions such as fear, greed, and panic. Investors do not always behave rationally, and psychological biases can drive extreme market events. Behavioral finance attempts to model these irrational tendencies, but predicting human emotion remains an unsolved challenge. The GameStop stock frenzy of 2021 is a perfect example. Driven by retail traders on social media, the stock soared to levels that made no logical sense based on fundamental analysis. No traditional mathematical model could have predicted that kind of collective behavior. Even when a strategy appears to work, real-world constraints can get in the way. High-frequency trading firms operate at lightning-fast speeds, often gaining microsecond advantages over slower traders. Transaction costs, taxes, and slippage further erode profits. Additionally, regulatory changes can instantly render a strategy obsolete. For example, restrictions on short selling or modifications to how dark pools operate can dramatically impact the effectiveness of certain models. Ultimately, while mathematical models, AI, and machine learning continue to advance, the market remains an unpredictable and ever-changing system. Some strategies may work for a while, but there will never be a single formula that guarantees success indefinitely. The best investors understand that markets are a blend of numbers and human behavior, requiring both quantitative analysis and qualitative judgment. As Benjamin Graham once said, in the short term, the market is like a voting machine, swayed by sentiment and speculation, but in the long term, it is a weighing machine, reflecting true value. Until we can perfectly model both the voters and the scale, the dream of a universal stock market formula will remain out of reach. Thanks for watching.